All right. Well, thanks everyone for joining. Julio and Jamie both here. But super quickly, this is our first ever episode of the Unbiased podcast. A little background on CryptoQuant is we're a on-chain data provider for crypto assets, so Bitcoin and basically any other crypto or token you've heard of. So today we're having Jamie on and also our head of research, Julio, to hopefully go over some macro, dive down into some indicators for Bitcoin. And really just generally get a pulse on what the market's like. So Julio, Jamie, thank you so much for coming.
Hey, thanks for having me, Ben. It's a privilege to be on the show for the first one.
Yes, exactly.
Hello, Jamie. Thank you for being here.
Yeah, it's good to see you.
Yeah, I had met Jamie. I think it's been maybe almost 2 years. And when you were working at Bloomberg, and then since then you've also I think founded your own analytics company and also heading out the analytics side of Real Vision. But yeah, maybe give a quick intro in case I missed anything. You're involved in a lot, it seems.
Yeah, time flies. It's actually been, I think, 3 years. So
yeah.
3 years since we're working with you guys as my primary Bitcoin data provider. But yeah, so background is in traditional finance. I worked in equities and macro, worked on the sell side and the buy side in Australia, Singapore, London. Spent a bit of time at Bloomberg, really 10 years on the technology side and working as a sort of equity specialist in Asia. Headed up a crypto team there back in sort of 2020 when the company was still trying to work out what it wanted to do in the space. Probably still hasn't worked out what it wants to do in the space, but in that time, I transitioned from leading the sales and product initiatives in Asia to Bloomberg Intelligence. Hadn't been a research analyst before, but I thought the area or the new asset class of crypto was fascinating, and it needed proper institutional coverage at the time. So that was when I sort of took my previous experience trading in equities and on the sales side, and really applied it into crypto, developed models, on-chain models, and macro and technical models. So really sort of a multidisciplinary approach to looking at the space to try and bridge that gap for institutions to start investing and allocating into crypto. And I stayed there for a couple of years, and then I joined Raoul at Real Vision in 2023, chief crypto analyst there. I've also spun up my own analytics platform. And yeah, I'm just basically serving the community at Real Vision, which has grown in leaps and bounds and now has essentially a social media type platform where content is being published in a sort of Twitter style fashion, and with Raoul and a couple of other really, really amazing analysts.
Awesome, thank you. Yeah, I guess quickly, Julio, too, if you could quick intro and give us an idea of some of the things you're working on.
Oh yeah, I'm the head of research here at CryptoQuant. Basically, the guy that makes the analysis for CryptoQuant and what we publish on our weekly reports or our research reports. Also working with clients to make analysis for them, content for them. So yeah, happy to dive into today's topic.
Yeah, Jamie, the first thing I wanted to ask you was really about the macro side of things currently. I remember you before, when you were a client at Bloomberg, you were working on these kind of quantifying metrics for the macro state and liquidity. And I'm curious right now what your kind of update is on that, or general take, and where are we at basically?
Yeah, well, I mean, liquidity is like this massive driver of all asset prices, and the correlations, and if you run these regressions on liquidity, they're pretty tight. The thing that you've got to remember, though, that is nothing is stationary in markets. So the relationship that asset classes have with factors, whether it's liquidity or other factors, changes over time. But the relationship itself is still liquidity. The liquidity relationship, that is still one of the strongest. In fact, it's the strongest driver of asset prices. And Bitcoin in particular, because it is a it is an asset that was designed as really the antidote to the current system and the sort of monetary inflation that we are now experiencing. So it is hypersensitive to that. And the thing that I think has been interesting in the last cycle is that the transmission mechanism has also changed. So it's non-stationary, meaning that we lived in an era from 2008 really to 2022, which was the QE era. And quantitative easing had a very direct impact on asset prices, and it really amplified sort of asset returns. Now, liquidity is still expanding, and we've had 4 years of expansionary global liquidity measured through global M2 central bank balance sheets, although they've played a much smaller role because of this sort of transmission mechanism that's changing, where liquidity is no longer being driven as much by the central banks through asset purchases, but it's really coming through the Treasury. Some people call it like Treasury QE, where the Treasury is issuing a lot of short-dated debt, and that can be consumed by the banks. And now they're even changing sort of the capital requirement rules to allow banks to consume or to buy more of this Treasury debt. And that just is essentially monetization of the debt, because that allows them to expand credit into the economy. So we have really seen a new era in liquidity. And now the new era of the liquidity that we're currently in is bullish for asset prices still. But I think the transmission mechanism, at least from my perspective, is a little bit different. And that's been playing out in the Bitcoin price. But you've also had other factors, just like the maturation of the asset class from the early adopters to ETF holders, now to institutions, and they hold different timeframes, different risk parameters, and different ways of investing in the space. So, I think we're coming up to the very pointy end, or the last phases of the liquidity cycle. Some have argued that we're actually on the downslope in the liquidity cycle. I think that actually, given that the debt is rising as much as it is, this year is going to be a tricky year for asset prices. Now we can get into whether Bitcoin has sort of bottomed and all that stuff, which is super interesting. Obviously, it's the core of what I sort of look at. But I think asset prices themselves, it's not necessarily going to be like a bear market year. It's just that the US debt is growing so much faster than the liquidity is growing, and that will eventually cause fractures and stresses in the system. So, you get a war on top of tight liquidity stress indicators spike, market goes down. Those liquidity stress indicators start to back off, things like the dollar, the MOVE index, bid-ask spreads on treasuries, and then the market rallies again. But when you have debt growing so fast and liquidity not matching it, you get the setup for a lot more volatility, and that's what I'm looking at this year.
So, Jamie, if I understand correctly, so you say liquidity is still growing? That's right? Okay. And so I guess the question that a lot of people have is when they see that, right, like the liquidity growing, but we have seen this year like a Bitcoin decreasing in price and also like underperforming basically every major asset. What would you say is the explanation there?
If you look at Q4, the contraction in liquidity was pretty severe. So we measured total global liquidity by looking at all the money supplies of different countries, the central bank balance sheets of other countries. You look at specifically what the US government Treasury, because it is a central part of the liquidity patchwork. And in Q4, you had a government shutdown. So the TGA was drawn down. You also still had QT. So despite the total global liquidity growing, so base money growing through credit, through the banking system, the central banks were basically a big drag on this cycle. And that was never the case before. Like central banks were doing QT, right? So we had 4 years where Bitcoin went up and the Federal Reserve was tightening its balance sheet, right? The total global liquidity, all the other factors overlaid, was still expanding. So you had a compared to previous cycles, there was a drag on this one because of what the Fed was doing. We get to Q4, and what happens when liquidity is excessively tight from central banks? We started to see issues in the interbank market in the US, like SOFR rates basically exploding. And that was essentially a sign that there wasn't enough bank reserves because the bank reserves were being sucked out of the system by QT, essentially. So what happened? The market collapsed. We also had the Binance deleveraging event, whatever you want to call it, rug pull, where basically, the market makers weren't able to perform their duties, and we had a massive crash in the ecosystem. That was a function of sort of the market structure and the lack of regulations, which we desperately need, and better systems and technology, compounded by also the tightening liquidity situation in the US shut down, and then the banking sector having issues with reserves. So that all contributed to a massive underperformance. Leading up to October, gold was outperforming Bitcoin, but Bitcoin was outperforming everything else. So we've forgotten that 2025 was a great year, except for Q4. Then obviously the unwinding that we had with all the derivatives, Bitcoin now is a derivative asset. You could argue that really it's been a derivatives asset for 5 years. Perps trade 4 to 5 times volume than spot. But it's the ETF derivatives that are now really driving things, and the institutions and the amount of, I think, convexity and all their structures that have been laid onto Bitcoin. Some people call it a paper Bitcoin, but the amount of derivatives overlay caused an accentuated, I think, decline into Q1 of this year. Now, QT was reversed, and global liquidity is expanding again. But that is essentially why I think we saw such a massive pullback and underperformance from Bitcoin. But there is this undercurrent, and I mentioned as well, debt is expanding faster than liquidity. And that is generally not good for, I would argue, for Bitcoin, because when there is excess liquidity, it flows into assets like Bitcoin and gold. When there's not, it doesn't as much. And the reason why gold is, I think, outperforming is because really the only central bank that has been adding liquidity, like expanding its balance sheet, has been the Chinese central bank. The Chinese buy gold, they can't buy Bitcoin.
Okay, got it. Any other macro factors that you think that have influenced this year's performance? Maybe, I don't know, the conflict in Iran, or maybe the Fed also, their stance on interest rates. What do you think?
Yeah, I think interest rates are not as big a part of the picture for Bitcoin as far as I can tell. Really, it's how well the system is behaving in terms of like the volatility in the US Treasury market. When you see the move index moving higher, that's generally an immediate pullback in asset prices, especially Bitcoin. So the interest rate cuts, and I don't think we're going to get interest rate cuts now because of the war. So generally, that's a negative for the economy, negative for markets. But if you look at the sort of business cycle indicators like the PMIs, new orders, actually we're in expansion and still expanding. So the economy's done quite well, and it's really just due to the AI build out and the capital demands that is having on the economy. Credit is still flowing in the US economy. The US banking system is expanding, M2 is expanding. That's flowing into productive assets. The US administration has been very determined to try and get the banks to start lending again, and that was one of the main drivers behind changing the supplemental liquidity ratio, the SLR, for the banks, that free up their capital so that they can actually lend more. So the US economy is actually performing really well, but you've got this inflation drag as well at the same time. And high inflation regimes are generally not good for equity prices. But at the same time, there is this insatiable, demand for CapEx that is still driving the economy, pretty strong. So my sort of view on how this impacts like Bitcoin is that it's generally good for Bitcoin that ISM is expanding. We've seen in previous business cycle expansion periods, Bitcoin does well, especially altcoins actually. Now, whether that's just coincidence, we've only got like 3 business cycles to work with because of the short-dated nature of the asset class. But typically we've seen like the altcoin start to outperform when business cycles in expansion. We've moved into expansion just in the last couple of months, but we've got a war that's now pushing up input prices. So that's why I think it's going to be a stock pickers year rather than just a broad-based market rally. There's going to be sectors that do very well. There's going to be sectors that really underperform. And I think, specifically in relation to Bitcoin and crypto, I think that, most of the bad news was priced into that February 6 wick low. And I use your data as part of my toolkit to look for what I think are capitulation lows. It had all the hallmarks of a capitulation low, except that liquidity is still in if we look at the cycles for liquidity, at the end of this year, it sort of gets towards the very, very end of the liquidity cycle. So typically Bitcoin does poorly in those periods. But if you look at just the way it overreacted in Q4 and early Q1, it had the markers of capitulation. So we're close to a bottom. Like what I've been saying in Real Vision is that, we are very, very close to the bottom. If we look at previous cycles, there's typically a leg lower if we are lining up with the liquidity cycle, but everything's out of sync, right? The liquidity cycle is out of sync with the business cycle, and Bitcoin's out of sync with both. So it's a bit tricky, but I think, in the 60,000 price zone, 3 years out, you're looking at, probably the best performing asset over that period.
I had one thing I wanted to get your take on. It was super popular on Twitter to try to map out a correlation between M2 and Bitcoin price. And we saw, I think a fairly large portion of crypto Twitter trying to follow that to play the cycle. Was that sort of the right intentions and wrong execution, or was it just too little of a huge factor?
Yeah, really it's Raul put out the M2 chart, right? And everyone sort of followed it. And the issue is that, on Real Vision, we talk about total global liquidity. That M2 is just one part of it. M2 is available basically on every trading platform. You can go to TradingView, you can map it out. But M2 is it's not a small part of the total picture. It is a part, but it is not the total picture. The other thing is that, the relationships between prices and these indicators are non-stationary. So, the lags that people use, and I've always said this, is you can't be tied to that lag relationship because it's going to change over time. Market as soon as the market picks up on a relationship, by just identifying that relationship, you change the outcomes of that relationship. Right? You front run it. It's arbitrage. So if something has stuck for a period of time, it will change as soon as it becomes it rises up into the consciousness of the market. But what we've always said is that it's total global liquidity. Now the other thing that I am different to Raul on is that I think the transmission mechanism or the type of liquidity matters. It's not just expansion of M2. It's the interplay between the debt and the liquidity. Which one's growing faster? Which one's lagging? And also the type of liquidity, meaning is it coming from the Treasury or is it coming from the central bank? The central bank is very, very blunt. When they buy assets, they're not giving the banks leeway to go out and fund productive uses in the economy through issuing of loans and credit to manufacturers and whatnot. Typically banks, because after 2008 were constrained in their lending practices and outsourced it to private entities, which has caused a another big problem in the market that I haven't mentioned, private credit and private equity, which is definitely in trouble. And a result of the reaction from the 2008 crisis, where after it, they basically, slapped the banks on the wrists. Not really. All the executives got their bonuses. Like, nothing really changed on that front. It was all good. They just couldn't lend as much. They stopped performing their primary function in the market. And so what did they do when QE happened, right? When the central bank was buying reserves or buying assets and putting reserves into the system? The banks would go and basically give it to their hedge fund clients, to their private banking, their prime brokerage arms, and just allow the hedge funds to access more leverage, right? And that would basically go straight into what do hedge funds do? They don't build anything, they invest. So that money flowed into asset markets, right? Through that transmission mechanism. Now, Trump administration is saying, hey, that's, Wall Street, you've had your time. Now it's Main Street's turn. We're going to get the banks back into the business of actually lending. And when they create credit, yes, it can go to speculative uses, but primarily it's going into, AI data centers, imports, from manufacturers. But it's basically capital expenditure to drive economic growth, which was pretty non-existent during the QE era. I've never argued that you take one chart and use that as gospel, especially when it's a macro to asset price chart, because markets are non-stationary and M2 is only a fraction of the total global liquidity picture.
And is it also because the growth in M2 was mostly China, right? You also mentioned that, right? And China bought
no,
instead, or is it?
It wasn't M2 that was growing in China, although it is growing. It's growing in most countries, right? Because the economy is growing, and so bank lending is increasing. Whenever there's a loan created, the base money grows, right? So a new loan is new currency, obviously, and provided the US dollar doesn't, because it's all, when you measure total global liquidity, you measure in US dollar. So a big factor is the dollar, the DXY, right? So if that is not appreciating greatly, then global M2 is essentially expanding, right, in dollar terms. Now that's one component. The other component is the central banks. The Chinese central bank was really the only major central bank that was growing its balance sheet. It was adding reserves into the system, and that was a huge, I think, driver of the gold price. So global M2 is expanding, no issues there. Some faster than others. We've seen some pretty rapid growth in some of the emerging markets. We've seen the UK basically flat or down, I think, last year. But it's essentially growing. But really, it's the central bank layer which has been the biggest driver of Bitcoin. And only the Chinese have really been adding until Q4, December 5th or 6th, when the Fed did the pivot, said, hey, we're not doing any tightening anymore. We're doing RMP, don't call it QE. It's essentially QE, reserve purchases, right? And they're just basically trying to add reserves into the system to prevent the same sort of the plumbing issues that we saw in Q4 when the SOFR rate started to explode. And that tells you that there's not enough reserves in the system. So they're trying to address that, but they're not going at it with the same vigor that they have in previous regimes. They're just trickling reserves in to keep the system running, but they're not really expanding their balance sheet at a great rate. Not enough to offset the amount of debt that's being issued from the US government.
I guess, yeah, maybe now to get into specifically for crypto, I think last year there was maybe two camps. One of like, this time is different. Maybe a Q4 top. Something will change, right? So, and now looking back, obviously we have some hindsight that it did sort of play out similar to previous cycles, peaking out in the Q4 post-halving year. But I'm curious your take generally on that timing and maybe even where we are now.
Yeah, look, I mean, I guess the 4-year cyclists were correct, right? And it doesn't matter. I don't think it matters why. It just played out that way. So in September, I wrote a research report at Real Vision, which said we were in line for a 30% pullback. And I was just using, at that time, the tightening liquidity conditions that I could see happening in the interbank market. And also the fact that if you just look at technical indicators, Bitcoin, I think one of the most powerful tools you can use from a technical standpoint is just zoom out onto the weekly chart and use a weekly RSI. And weekly RSI divergences have been this thing that I've used throughout my entire career. In hindsight, the first time, because I wasn't using technicals when I first started in the market, but there was a massive RSI divergence in the S&P in 1998. It started in 97, and then there was a series of higher highs in the S&P and in the NASDAQ, but lower highs on the RSI on a weekly. If you look at a daily chart, it's just too much noise. You look at a weekly. Now, what it tells you is that there is momentum degradation in the market, and then you can use other tools like breadth indicators and whatnot to see if the underlying structure of the market is on a really weak footing. You don't know what's going to kick it off, but you know something could kick it off because the market is structurally weak. 1998, it was LTCM, the market fell 25%, the Fed came in, cut rates massively. We had the biggest bull market in NASDAQ ensuring over the next 2 years, and then we topped in 2000. The same pattern played out in 2007 across most equity markets. The S&P, I was trading Japan at the time. We had it on the Nikkei, and I knew that basically that there was structural weakness, and of course the GFC happened, and subprime and everything kicked off the GFC. In Bitcoin, it was the first ever weekly divergence that I saw leading into September, October. So I was right in calling a pullback. I was wrong in thinking that it was the end of the cycle, because my view was 30% pullback and then off to the races, and then we'll peak sometime in sort of the middle of the year. So that was my thesis. The part I got right, the part I got wrong. Now I think it's interesting because typically a bear market takes 12 months in Bitcoin, right? If you look at the previous one, so October was the high, and we are on a normal cadence, then 12 months from now we should sort of bottom out, give or take. But we also had a couple of, there's a couple of other things that happened that sort of give me a little bit of pause. Number one, the speed of the decline was as great as previous bear markets, right? There's basically a 50% pullback. 50%. The velocity of the move, Julio, would you agree, it was stronger than it was in 2022, right? It happens much more faster than it did in 2022. And then you look at like the volatility of the asset. The volatility of the asset is maybe half of what it was in 2021. So is a 50% pullback the same as a 70% pullback in previous cycles? Quite possibly. And what's to say that it didn't price in everything in 6 months, and the next sort of 6 months is choppy and up? I mean, that's kind of my view. I have technical indicators that I use for saying, hey, it has now broken the downtrend. It is now based on all previous cycles, most likely in a new cycle move. We're not there yet on the weekly charts that I'm looking at. On the daily charts, it's started to turn up, but we're not there on the weekly. So that's kind of like, I'm in the camp that that I would count the October high as the cycle high.
Do you think that we already saw like the bottom, 60K was the bottom? Even if we don't start like a bull market, the 60K was the bottom for the cycle.
I think there's a very good chance of that. And like I get asked this question all the time, Julio, and my answer is like, everyone gives me shit for it. But it's like, the bottom several months after the bottom. Everyone wants to be a hero and say, on February 6th that this is the low. And it had all the markers of the low for sure. But like, you only really know after the fact. And that's why I use technical indicators to overlay, just to say, okay, there's a capitulation low back in February. Let's just see it start to break meaningful resistance levels on technicals over meaningful time frames. So weeklies are generally good for that, to confirm it. And that's what I'm sort of looking for. But yeah, I think there's a better than 50% chance that it is the low. But if we pull off from here, it might test that low. There's still a decent chance that we get one more week down. But like, for people who's listening to this and thinking about investing, and it's really a question of time frame. If 60,000 is the low, these are really good levels to buy at. If it's not, it's still in the what I would call the value zone, right? Julio, I use your data, the MVRV Z scores, SOPRA Z scores, various other things on the on-chain side of it puts it in my reckoning in the value zone right now. That doesn't mean it's bottomed, but it's in the zone where you get the best returns over a 4-year period. So it's kind of like, if you're trading it, okay, maybe now's not the right time, right? But if you're a cycle investor, if you've got a long-term perspective, you're in the value zone right now, whether we get this week lower that we're all talking about, or whether the February low was the low and we break out to the other side in a couple of weeks.
Yeah, agree with that.
Yeah, I think now might be a good time to pull up the charts that you had.
Exactly. Yeah, Jamie, we put just a few slides here. It's charts about our metrics. So I'll explain a little bit, and you can of course comment, or if you have another view, another idea. One of the first charts that I am showing is the on-chain trader realized profit and loss, unrealized profit and loss margin. It's something that I follow a lot to see if Bitcoin is overvalue or undervalue on a more like a shorter term. And actually here you see here like you talk about the February 6th being like the capitulation, right? That you saw a lot of those metrics. Funny that this metric around that February or early March, it was showing that the traders experiencing some large losses, unrealized losses there. That's typically when I say, okay, maybe the prices has decreased too fast, right? So that's basically the idea on this chart. And since then, what we have seen is that the price has recovered, right? Because there's too much unrealized losses, and then so there's no more room. Maybe there's no more room to sell from the trading side. And so after that, we have seen that the recovery of Bitcoin price towards the trader realized price, which is right now at 76K actually. So the price is right there. This is what I would say is a really tough resistance. And so that's one of the things that you are also saying, that we need to go above some important price resistance and thresholds. That for me will be one of those, like 76, right? Because at that point the trades are break even now, and so if we are in a bear market, that will say this is a resistance. If not, then we can go higher, right? So that's a really important time. Yeah.
Can I just ask? I mean, do you have a chart of this capitulation low relative to the say 2022 in terms of how extreme it was?
Yeah, I mean, I don't have it right here. I do have like the entire history. What I can tell you is that it was, I think 2022 was, a bigger, more negative unrealized loss. Yeah.
Yes. One of the things that I'm just remembering from my dashboard, in 2022, I had things that I was looking for that mapped well to the 2018 low. One of them was realized losses, just realized losses, but not in nominal terms, in percentage market cap or market cap adjusted.
Okay.
And that level, that indicator spiked to, I'm trying to recall, it was as big or bigger than the June 2020 low, which was the big wick down. Then we had a bit of a recovery. Then FTX took us to a new low. And then, so there was two massive realized loss spikes in 2022. And the February 6th low mapped very, very closely to those two big spikes in terms of the magnitude when you adjust them for market cap.
Okay. Yeah. Interesting. Yeah, that's really interesting. So the idea is that, to here show that capitulation, right? And then that we are in a really, also like a key resistance level there for Bitcoin. Well, yeah, it could be like this is, as low as we may see this type of metric. Oh, the next one is to talk about a little bit of the demand for Bitcoin. Like a lot of talk is that this cycle is different in terms of there are other players, right? There are ETFs that we didn't have. There is also MicroStrategy, which is buying a lot. And so, yeah, I'm curious to get your thoughts on that, because what we show here is that, between ETFs and MicroStrategy, they are, buying more than basically this other metric that we call the apparent demand growth. So they're growing a lot, and that's something that we didn't have in the previous cycle. And so the idea would be that maybe this bear market is, let's say, smaller because we have a source of demand that we didn't have in the previous one. What do you think there, Jamie?
Yeah, I'm sympathetic to that theory as well. And it's because like the ETF buyers are being driven primarily through private wealth channels, and private wealth channels invest differently to, Bitcoin plebs and the degens that have dominated like the asset class for the first decade. They tend to buy dips, right? And they also rebalance more often. So they may have a structured portfolio or a portfolio allocation framework, which has Bitcoin sitting at sort of 2%, 3%, whatever the case may be. And when that underweights or when that drops below the benchmark weighting, then they'll add, and when it when it outperforms, they'll trim. And that could be a big change in the market structure going forward for Bitcoin in terms of potential returns, but also in terms of the volatility. So yeah, I'm sympathetic to that. Like, it's all like theorizing at this point, but it certainly looks that way.
And the other one that I'm looking at, in terms of like liquidity, I mean, I know that you make a lot of measurements of liquidity on the macro side. In terms of the crypto side, I just tend to focus on how the USDT market cap is changing, specifically the growth. And you see that when we enter this bear market, it coincides with the liquidity of USDT, the growth in the market cap. This is decelerated, and then we even showed a decrease in the market cap. On March it went to a low of 3.5 billion, so a decline, and now it's growing again. In the last few days has been growing, and it's growing by now 3.5 billion. So that's another sign that I look at in terms of liquidity, but more specifically for the crypto market. I'm curious just to know, how do you see or look for liquidity, but specifically for the crypto market?
Yeah, so I would love to see this as a Z-score, right? Because what is 3.5? I think this is excellent. Like, I mean, I don't have this in my dashboard, and I have the data, so I'm gonna definitely look at it. But what I would do is just look at the magnitude of that decline also, and the rate of change increase that we're seeing at the moment, and then look at historically how much was that 3.5 billion decline in. So because like structurally, or should I say, yeah, you can call it a structural shift or a secular shift. Stablecoin supply is expanding. It's in a mega trend up and to the right. So, it's the oscillations in that overall secular trend that's interesting. I think it'd be interesting to measure it sort of like as a Z-score, like just to get it normalized. But like how deep was it? And if it ever was that deep, have we come out of it as fast as we have here? Because that looks like a very big turnaround, and I wasn't aware of that.
Yeah, that's interesting to see it as normalized. Actually, it could give you like a more accurate metric. But yeah, that's one of the things that I always follow in terms of liquidity for crypto is USDT market cap, but the growth actually, like you say, not the overall balance, but the growth in that, right?
Yeah. Well, and is there a reason why you haven't added USDC there as well? Because of the USDC's popularity within DeFi. It wants to be a good.
I focused a lot on USDT for this, just because it's used more like for the trading purposes. There's in terms of like reserves on exchanges, USDT is much like bigger for trading purposes than USDC. So that I think that it follows more that those market cycles than USDC.
It could be. Yeah. That's interesting.
And well, finally, just by looking at it into inflows into exchanges after this rally, from the 60 that we saw here in I'm sorry, this is this week. We had this rally at 76, and now we see a spike on inflows to exchanges. So just that to give a little bit of let's say an alert or warning that typically that happens, when we had some rally and we can see the inflows to exchanges, so to expect a little bit of a pullback, or it's always that important to keep an eye on this type of metric.
I mean, this is actually something else that I've neglected to use, but I'm not sort of trading on the short term anymore. But I would be really interested to see this on a longer time frame and a more smooth metric, and also like normalized to the market cap as well.
Well, Jamie, one thing I wanted to ask, because we've touched upon, macro, now some technicals, but specifically how you approach, I guess, investing in Bitcoin. It seems like that maybe there's a macro like bias helps you establish, and then you have a set of technicals to kind of dive in for timing. I guess what's your process in general?
So the thing there is also on-chain, like all the Julio stuff is critically important. I tend to use the on-chain for Bitcoin more for understanding the major turning points. So, back in the day before ETFs, general activity on the chain was indicative of price moves. So, how much money was flowing across the chain. And I don't know if you want to, like, for me, I think it's a sad reality that the chain is not being used for its really original purpose. It's just basically becoming a hodler asset. But those metrics, those network activity metrics, and Julio, please weigh in here. Like if you found anything that you would disagree with here, because I'd be fascinated to know. But like the network activity metrics don't really have a great correlation with tracking the performance of the asset anymore. And most of the activity now is happening off-chain, right? It's through the ETFs, and they don't leave the same sort of activity footprints as before the ETFs were launched. But they certainly, like on-chain metrics, are critical for understanding cycle turning points or major low, major top. So I use that. I have a toolkit. I've talked about it here, like the realized losses. For capitulation lows, realized losses, the funding rates, futures positions losses. they're all like, when you start to look at them, normalized for market cap, because that's the I guess the thing that I see people on Twitter mistakenly do. They go, well, look, it's the biggest liquidation day. Sorry, liquidations is what I meant in derivatives, right? So liquidations and derivatives positions, realized losses on spot funding rates. But when you see liquidations not normalized for market cap, it's like, what the hell does that mean? Like, Bitcoin's 5 times the value of it was in 2021, right? Or 2020, I should say. Of course, it's going to be a high liquidation day when it has a big down. What is it normalized for market cap? So I use those, and they are very good bottom indicators. But you only need them a couple of times, arguably a year or over a cycle to understand things. But it's on-chain data for understanding those highs and lows, because I have my own Bitcoin cycle risk score, and I use CryptoQuant's data for understanding like long-term holder selling as a major turning point for cycle tops, and a couple of other metrics, MVRV, net unrealized profit loss, all these things combined into my own custom metric that I use for real vision. But then it's also like the secular macro stuff as well, Ben. Like, why are we here in Bitcoin for the first place is because it's an asset that has an answer to the problems of the current financial system. So understanding how that financial system is operating, what levers the central planners are pulling, certainly has an impact on the asset. And then, I'm a technical analyst actually really to my heart. So I have to overlay technicals on top to understand, entries and exits and the health of a trend as well. So I call it multidisciplinary, but it's like, it's macro, it's on-chain, and it's technicals.
Julio, I bet you would agree with that.
Yeah, of course. I mean, I'm not much of a macro analyst, but it's just because I've never done that. But yeah, I mean, on-chain, I also, a lot of what I follow is flows, like exchange flows. Specifically for tops, it gives you, they spike actually, and if you see it on a longer term, longer time span, it also like spikes when there's like tops and that. So it's really helpful to look at flows into exchanges. I will add that, but yeah.
And I think
you've got to get your CMT designation, the Chartered Market Technicians designation. We need more crypto on-chain analysts. It's something that I've been trying to drive with the designation now. We're actually I wrote the syllabus for the CMT on crypto using a lot of the on-chain data from CryptoQuant. But yeah, I think it's the crossover between technicals and on-chain is just a perfect symbiosis. It's all data, and it's all visualized in a chart. So the crossover from understanding the technical indicators onto on-chain metrics melds really well. So that's my pitch for you to get your CMT.
Sure.
And on the indicator side, it seems both of you are very aware that it's a little too easy to just pick a value of historical metric and try to place it on today's. Like Jamie, you've mentioned many times normalizing data for the current market. And Julio, like you don't just take the MVRV from 10 years ago and try to apply it to the price today, trying to find exact tops. So yeah, it seems like that's a pretty good theme.
Yeah.
You guys are taking data at the face value. You're really trying to understand it today.
Yeah, normalizing data is absolutely critical, which is a bit of an art more than a science, isn't it, Julio? Like then you get into the trap of trying to overfit periods to match. But the exercise of doing that eliminates some of the bias or the the sort of too easy to really activating much of your gray matter when you just see a chart that looks wonderful in one instance and not actually understanding the full picture. So some sort of normalization is just really healthy.
And moving into the, I guess, broader crypto market, now that we've scratched the itch for all the Yeah, like on the altcoin side of things, it seems like the fundamental Bitcoin crowd, like a lot of indicators are built out. Maybe for altcoins, it's a little more challenging to find like a good set of on-chain data for actually like pricing out like valuations. So I'm curious your process for the altcoin and the broader crypto space.
Yeah, I'd actually push back on that. I think there is definitely good data to understand the health of a layer one and also a DeFi protocol, which is essentially the two main sort of use cases these days. The relationships change, but there is a lot more. I think there's a lot more people looking at the data with a better framing than there was maybe 3 or 4 years ago. And what I mean by that is, if you look at sort of fees, right, the fees that an L1 generates, like settlement fees, the common trap is that you look at fees and you see them going up, but people don't distinguish or delineate that fees are priced in the currency of the L1 token. So fee activity may not be increasing, but the token may be going up because there's more demand, more speculation for the token, and fees are actually rising, right? And so that's a sort of a false signal. Also, if you look at fees and you see big spikes, typically that's really horrible for forward returns. So one of the stuff that I do is really statistically breaking down what drives the value of an L1 token primarily, and thinking about it not from like a short-term trading perspective, but from a structural secular trend. Over time is consistently a broad range of different measures increasing for this asset, right? So fees, stablecoin supply, the number of applications being built on the L1, how many of those applications are profitable or are generating fees above how much supply is being generated, and then looking at the L1 token supply schedule and understanding, what is the inflationary nature of that L1 token, how much vesting is going to take place, and then trying to sort of distill it down to these networks are structurally strong and growing, and these are essentially networks, and they follow Metcalfe's law or Reed's law, where just more activity on the chain and more interactions between all the different nodes on the chain, call it applications, call it users, is going to actually increase the value of the underlying infrastructure. So there's a lot that can be gleaned from on-chain data for L1 tokens. DeFi tokens, they're kind of like businesses, they're kind of like stocks, where they're just really just, they're businesses on chain, and you can measure them in terms of cash flows, like discounted cash flow models, but you also need to take into effect the supply as well. So yeah, I mean, it's intellectually fascinating because there's a lot more complexity than to Bitcoin itself, but it's a harder place to invest because it's a VC asset class traditionally. Most of the VC funding though in the well-established networks is gone. Right, Solana's 90% through its inflation supply schedule. The VCs are kind of out of it now. They're buying it, but they're not. The initial investors vesting are kind of out of it, and so you don't have the overhang that you did for the first 4 years of that token. So now it's basically price discovery, where increasing demand is not being offset massively by supply, and so the demand factors will actually really start to signal price performance.
I think one thing interesting last, cycle, if we're calling it over, was that many of the, blue chip L1s didn't even reach an all-time high. Many would expect in previous cycles where, every coin is just pumping to new blow-off tops. But it seemed like there was only a few, like Hyperliquid, and some other ones formed. So do you see a consolidation happening in some of the fundamentals of these real projects, I guess?
So BNB, Tron, Solana, they're the top three they're three in the top four. Ethereum didn't. Ethereum came close. So 3 of the top 4 hit all-time highs and actually outperformed Bitcoin. I'm just trying to remember. I did the rankings at the end of the year. Sorry, at the start of this year. And so, because I was talking about like October being the end of cycle, so I wanted to go back and like measure what happened in that cycle. We were surprised that it ended. Now let's do the post-mortem. And so BNB, Tron, no one talks about Tron, and like, let's face it, but it has crushed it. BNB, all-time high. Solana, all-time high back in December of last year or January of 2025. Traded down for most of the year. But the point being is that the assets where there's activity grew faster than Bitcoin. And so the issue is not, the whole altcoin space underperformed. Yeah, but like, there's too much supply. And no one's adopting it. No one's using like the 5th L2 on Ethereum, right? No one's using the 6th L1 in market cap rankings. But the growth numbers, the active users, the stablecoin growth, the transactions, the settlement volumes, the DEX volumes on some of these are exploding and have consistently grown. And that took them to new all-time highs. So the alt season thing is definitely dead for everything other than the stuff that matters. And the stuff that matters is a fairly small sliver. Like I've created crypto indices, crypto sector benchmarks. So I've got 7 sectors. I've got the top 200 index, the top 100, top 50. I track all this. I do breadth measures and all this. So I dissect it in great detail. And it's just obvious. Like the networks that matter, that are being used, will go up in price. And provided those metrics are increasing over time, with a lot of oscillations, obviously liquidity cycle playing a part, these things will be higher in years to come. And could even outperform Bitcoin.
And I guess the types of activities that you're focused on as well on these networks, like the big 3 that you listed off, I mean, primarily trading and stablecoins are the utilities, not necessarily. I mean, marketplaces and NFTs obviously exist there, but what's excelling those networks is stablecoins and trading, essentially.
Yeah. So the way I've defined it in my research is you've got the speculative, because L1s are the digital economy, or the L1s are countries within the global digital economy, right? So Ethereum's a country, Solana's a country, and they all have different taxation, taxation and immigration and other policies that govern their economy. They've all got their own individual jurisdictional sort of policies, but there are 2 structural sort of drivers of the price performance of the assets, of the L1 tokens. It is the speculative economy, which is DeFi, and when there is increased intensity of usage, it is very closely related to L1 token price. Then you've got this slower burn structural driver of the prices, which is essentially the settlement of stablecoins and transactions and payments. That has less of an impact on the day-to-day price, but over the long term will determine the performance of the assets, because that is less cyclical than the speculative economy, right? You can see a meme coin explosion happen in one ecosystem the last 6 months, and it'll drive the price. And because it's speculative and it has a finite, time period of basically destroying everyone's money, because that's what they do. 99% of meme coins, traders lose money. So it'll suck money in, everyone will lose money, it will die, and it will be reborn in a couple of months because we're humans and we can't help ourselves. But underneath that is, you've got to ask yourself, is that L1 building the stablecoin economy of the future? And if those metrics are driving, then that is really the long-term determinant of success for an L1 token.
Julio, do you have any takes on the altcoin side of things?
Yeah, no, I agree with that, especially the stablecoin use case, right? it's like I would say like the more boring side, but it's the one that is really driving adoption, and you can see that on Tron. We have made research on Tron over the years. It's what they really find the use case right there in the stable coins, and as you say, Jamie, TRX and Tron are the ones that one of the coins that really got to new all-time highs this cycle, right? Because they, over the years, they continue to add more and more stable coin liquidity and of course more transfers, more activity, and just basically what happens in that network is a stable coin. That's the activity there.
But as a transfer mechanism, it's got found product market fit. The other thing too, Julio, is like it's got a very effective tokenomics policy. Is it burning 100%?
Yeah, it's burning it. Yeah, exactly.
So of course it's going to go up. Like people are using it only for one thing. So like I would argue that is why Tron trades at a significant discount to Ethereum, even though it has 4 to 5 times the daily fee revenue. And all those fees, I think, I could be wrong, but 100% of those fees I think are burned. So you just have this continual price, it's like a massive buyback, but the market discounts it because it doesn't have diversity. Its economy does one thing. So if something comes along, like maybe, Stripe and Circle with their own corporate chains start to really take over stablecoin flows, like that's the big risk for Tron. There's no evidence as of yet that they could displace the network effects that Tron has built up over 6 years, especially in emerging markets. But it does trade on a discount because it doesn't have diversity in its ecosystem. It just does one thing. But that one thing is actually the most valuable thing in crypto.
Awesome. And the fun thing is we can track it all using CryptoQuant, actually. One final question for you is, I think with this podcast, one of our goals is to give the average crypto investor some insights or tools to kind of navigate the market. So I'm curious if you had maybe one final advice for the average crypto investor, because we've talked about, general macro, geopolitics, how that affects price, all these different tokens and indicators. But do you have like a general framework you could share, or any simple advice?
Maybe I'll just share a couple that come to mind. Number one is, I think unless you have, a remarkable skill for picking tokens, the best thing you can do is invest where there is usage. And the second thing I would say, I'll come back to that first point. The second thing I would say, if you're investing in token and you follow that principle, like where are the users, where is the liquidity as your sort of guiding investment framework for picking the tokens. The next question is, how do you size the crypto allocation in your total investment portfolio? And that's where I think a lot of people get it wrong. Like even if you're 100% bullish on Bitcoin and crypto and its future, unless you're willing to accept the 80% drawdowns that happen all the time, then you shouldn't have 100% of your investment in crypto, even if you're following the right methodology of buying the assets that have the usage, that have the liquidity, that have the network effects. So that would be my my guidance.
Awesome. Well, thank you. I think that's great advice. And yeah, thank you very much for being our first ever guest on Unbiased. And I'm sure we're going to link all of your projects and socials when this is released. Yeah, really, thank you.
It was a pleasure. Thanks for having me on, Ben. It's a privilege to be on the first of the series.
Yes,
well, thanks for the work that you're doing on your side as well. I love the content that you're putting out.
Thank you, Jamie.